So let's get started. A very warm welcome from my end to Moonfare's Deal Talk episode today. My name is Steffen Pauls and I'm the CEO and founder of Moonfare. Dear audience, what we do at Moonfare is simple. As largest digital direct-to-consumer platform for private equity in the world, we are accessible in over 23 countries across the three major continents in Asia, in the US, and in Europe. We are spearheading what the industry calls or is referring to the democratization of private equity. This is Moonfare's mission. So we give private individuals and their advisors the opportunity to invest directly into some of the most sought after private equity funds in the world, including buyout, growth, and tech. From managers such as KKR, Permira, EQT, Khosla, Silver Lake, or Insight Partners. And all this is starting at low minimums. Depending on your jurisdictions, it can be 50K for a given fund investment, and we are doing this through an entirely digitalized process. If you would go now to the Moonfare platform and would register, it would take you less than 2 minutes to do so. But pictures tell us more than 1,000 words. So let's have a very quick look into a short video to kick things off. I'm very much excited to welcoming Jeff Lieberman as a guest today. Not only as he is a legendary tech investor since decades, but also as Insight Partners is one of the major investors behind Moonfare and a fantastic partner to the firm. Jeff has spent the last 25 years at Insight Partners, where he has worked to help scale Insight, the world's largest growth-oriented software investment firm. And he has seen the enormous power of people and ideas and their ability to disrupt the world. Jeff serves on the board of numerous private and public companies in both consumer internet and software. He has led stellar investments in leading companies such as Qualtrics, DeliveryHero, HelloFresh, Cvent, Mimecast and Udemy, just to name a few. Jeff has received numerous industry awards, including being selected by Always On as a Venture Capital 100 winner, by Forbes as a member of the Leaders List, and by GrowthCap as a top 5 software investor. Jeff, you, Insight Partners, have a long-standing history and track record in the tech investing. So allow me to go back a little bit in time. And let me ask you, Insight has long been a leader in growth stage software. What originally drew you to this specific part of the market? Jeff, you're on mute.
Yeah, good morning, Steffen. Always start off that way. My story in starting software is a little circuitous. My dad's an electrician. Neither of my parents went to college. So I always had this hankering that I wanted to be an entrepreneur. I just didn't know what it meant. So fortunately, when I was in college, my college roommate's father, or best friend's father, was one of the early partners at Sequoia Capital. So I was regaled with these tales of amazing venture investing and the power of technology. So I tried to get into the business and applied to literally every venture capital firm, and they all rejected me. So at that point, I did what any self-respecting college student would try to do. I became a consultant, spent a couple of years at McKinsey, and still wanted to be in the investing business. Mid-90s, it was the first .com craze had just begun, and wanted to join the fray and become an entrepreneur. I just didn't know how to do it because I was never taught that as a kid. So I ran into my partner, Jeff Lieberman, who had just started this little fund called Insight, and he had this idea that software was going to be really important in the world. And at the time, hardware was actually a bigger piece of the IT slice than software as a percent of revenue. And his basic thesis is that we should invest globally. in growth-oriented software companies. And literally that's the pitch he gave me. And, roll the clock forward 25 years, and that's still what we do. We do it in growth companies globally. So it's been an extraordinarily consistent and simple strategy, hard to execute, but a simple strategy.
Look, drawing a little bit on your vast experience, what would you say, how does growth software investing look different as of today than if you compare it back in the mid-90s, especially in the post-COVID world?
Yeah, I mean, it's a great question. The mid-90s software, there wasn't much software, right? So the industry was extraordinarily small. It was a cottage industry. It was not really global. And the technology was really client-server based. So you were installing stuff at the client. So it was hard to install. Many of our companies, the software didn't really work. It would work in a lab, and then you'd go to the customer place, and it would be a different configuration of hardware. And the software wouldn't work because you're running on different hardware configurations. So along comes in the post 2000, I did my first SaaS deal. We called it on-demand in '99, but that really took off over the next decade, kind of the early 2000s, and that fundamentally changed the scalability, ease of implementation, and portability and extensibility of software. So it fundamentally changed our business and made it from a cottage industry to a big industry. And then, along comes COVID, and what the world recognized, both at a user standpoint, businesses and consumers, as well as investors, is that, wow, like you can really run everything, and everything's going to need to be somewhat softwareized, for lack of a better term. And we saw just a massive pull forward of demand in COVID. And really, we got a glimpse of the future. I mean, that's really what happened. We saw 5 to 10 years into the future, and right now we're probably digesting some of that. But it was a very, very unique time for us to see forward, which we don't normally get in our world, which is really just an amazing, an amazing opportunity.
Jeff, you mentioned SaaS, and that has been a focus of the firm since the beginning, it seems. Would you share with us, within software as a service, what type of investments are of particular interest for you?
So, generally we're a big fund. We look at everything, right? So our general thesis is that the software business model is fundamentally an amazing model. It's highly recurring, high gross margin, and if done well, delivers very large cash flows in the long term. So these are just great businesses. And then we think about, where do the problems exist? And they exist in every vertical. And then there's a whole infrastructure layer, and then there's a whole security layer that sits, underneath it all. So we're pretty agnostic relative to where it sits, and we just see it across really the spectrum of opportunities. So we kind of like it all, and within that, we just, choose our spots.
Thanks a lot for sharing this. Look, I want to switch gears a bit, and as unpleasant as it might be, and ask you about the current market.
Yeah.
What are your views on the recent interest hikes and the potential recession we are heading into? And maybe more particular, what can we expect this year in the firm's view, in your view, and going forward? What might be a changing trigger point in the future that, call it, brings things back to normal?
Yeah, let me start by saying I'm not an economist, right? I'm the son of an electrician. But when I talk to my dad, he complains about gas prices, and I'm sure you're in Germany, people are complaining about energy prices. And if you read the pundits and the economists, they'll say, there's a high likelihood we're either in a recession or going in a recession. So I think, we're sober, and, we're not predicting that, but we're just looking at what other people are predicting, and we're assuming that will be the case. Just given Fed action and what's going on. So, that's kind of our base case, is that, likely the economy will be harder, over the next 12 to 18 months. And at some point, cycles come and they go. And at some point, things will actually pick up again once we go through whatever cycle we're going through.
What I find striking, Jeff, is when we talk to our investors, is really the sentiment. And if you go back and based on data, tech emerged out of every crisis over the past 20 years even stronger. Take 9/11 post, take financial crisis, you have always seen it. take this crisis, and there are tons of data that tech even outperforms in recession periods because of the disrupted nature of the beast. What is your explanation why people struggle so much to understand that the time to invest, in particular into tech as well, is now, and not to shy away as people did so post 9/11, saying tech is dead? I heard the same when I was with KKR post the financial crisis, tech is dead. Some people now shy away from tech. It's very counterintuitive after all these experiences made, and if you read the data.
Yeah, it's a great question. I mean, I think, first and foremost, I think it has a lot to do with human psychology, right? We love to invest in things when they're going up. And we hate to invest in things when they're going down. Right. So we're if you look at just software pricing in the public markets, we're at historical lows. A year ago, we were at historical highs. A year ago, everyone on your show, I'm sure, was like, tech is the greatest thing in the world, and you have all these inflows. Today, like, tech is the worst thing in the world, and you have all these outflows. And psychologically and sociologically, it makes no sense. I mean, I think it's the history of bubbles. It's the history of investing. It's just how things go. If my dad taught me one thing, he was a Vanguard investor from day one. He's like, every month, put $100 in your Vanguard, and kind of, if it's up, great. If it's down, great. Just put $100 in forever. And, that's what I did starting when I was, old enough to get a paycheck. Right. So it's just this notion of just continuing investing through the cycles. So I think there's some consistency to that. The highs are never as high as the highs, and the lows are never as low as the lows. And it's hard to do when you're in the midst of it. But I think that's the psychology. The second point I would make is in terms of why does tech come out of these things? 9/11, the great financial crisis in 2009. Why does tech come out well? When businesses look at how they're doing business and they need to get more efficient, there's really only one good global answer, and that answer is to transform your business with technology, which basically equals software. And if you want to drive more growth, you want to drive less cost, it fundamentally comes down to software. And so I think coming out of these things, there is a step function change. And if there's any friction in these systems to not allow transformation to occur, the financial situation around us actually reduces that friction. So in general, it's a little painful in the short term, but I think long term, it actually propels forward adoption of technologies to drive change.
Look, let me ask you about how you deal with the portfolio in these days. One of the many reasons why we at Moonfare are delighted to partner with Insight is the strength really also of your operational resources on the portfolio side. And there was a recent article with one of your managing director of Insight on side. It was with Hillary Gosha, and about how the team is helping portfolio companies to remove what she called the fluff in the system. Can you talk a little bit about that and how your hands-on team is supporting portfolio companies in these days?
Yeah, from day one, what we built was an operational team to help companies grow faster and more efficiently. And we think about it across the functional areas in a business. And we basically built, it's a couple hundred people that go in and help our companies think about efficiency. And in a time where capital is more expensive, and at the end of the day, stock market pricing, it's just more expensive today than a year ago to raise capital and use capital. So efficiency becomes more important. And our teams go in, these are second career professionals, people who have spent their life building software companies. They go help entrepreneurs and teams build their businesses more efficiently. And that's function by function by function, from sales to marketing to partnerships to technology. And that's what they go and do. When capital is very cheap, which is really what was last year and the year before, founders and CEOs are less concerned about the cost of that capital and the use of that capital. When capital becomes more expensive, which is what we're seeing in the market today, which, by the way, as an investor means that you started a lower price, right? So there's some funny incentives going on, but they're more open to getting help because they need to be efficient because they don't want to take expensive capital. So it's a very interesting dynamic in time.
But when we take a look, Jeff, at the public markets, and partially, even good growth tech companies have compressed in valuation by some 50, 60%. I just had this morning an interview with one of the larger newspapers in the US, and the reporter was asking me, why are we seeing such a compression in public markets? But when we take a look at the valuation in private market companies, and he was mentioning a couple of your competitors, we don't see the same level of markdown. What is really the reason for it? Is it the time lag in terms of when you really have to revalue your portfolio? Is it which leads to obviously lower volatility? What would be your answer to his question?
Yeah, I mean, the public markets are weighing things literally, minute by minute, day by day, as the public markets are open. The private markets in general, they just lag. I mean, that's, historically been the case. There's less data. No one's trading these securities on a minute by minute basis versus the public markets. So there just takes time for the system to do that. And, we continue to see deals get done at really interesting prices. Some do, some don't. So whereas the public markets, they weigh it immediately. So I just think there's a lag there. And, in time they do meet, and it just takes a little bit of time.
But we did a quite interesting, I found, analysis in terms of public market valuations applying the rule of 40. And what you see is why the average is down quite significantly, the market clearly differentiates between those that fall below the rule of 40 and those that are, in different territory. Is it also a way you look using this metric at your portfolio when it comes to valuation, and how much of a role does it play when it comes to new investments?
Yeah, I mean, to me, I start at the most simplistic level. At the end of the day, I mean, I think about all investments as future cash flows, right? So at the most fundamental level, what any investor should want is certainty, or as much certainty as possible, on some future cash flow. It just so happens that software has the opportunity to drive very high cash flows that are very predictable and very stable, and they can grow. So if you start with that, the premise that everything is a cash flow, and you can kind of value that, ultimately how much cash flow you have in the future really becomes the key ingredient to how you should value something today if you're making an investment. So ultimately, the balance between growth and profitability is something that we think about all the time. And if you had a business growing 30% but couldn't make money, or you have a business growing 30% with 30% cash flow margins, one is clearly or likely a lot better company than the other, knowing nothing else, all else being equal. So we think quite a bit about those trade-offs, and ultimately we orientate our companies long-term to the notion of you're going to get valued based on your ability to generate cash, because that at the end of the day, the ultimate holder of a security is going to want cash flows. And that's a pretty simple rule that, I always fundamentally go back to. It's about the cash flow at the end of the day. We can argue when the end of the day is. It might be 5 years, 10 years, 20 years, but it's ultimately about how much cash flow we're delivering in the long term.
Look, let me ask you a pretty pragmatic question as a founder. When we ask, experienced tech investors, what is a healthy or cash runway for the time we are in for a portfolio company? We are hearing ranges from as low as 18 months, which I find on the more aggressive side, to up to 5 years. What do you advise your portfolio companies?
Yeah, that's a great bookend of a range. I would say 18 months would make me uncomfortable. And I think 5 years is a lot of runway. So, I think practically speaking, if you're 2 to 3 years, I would say at least 2 and ideally 3 would make me sleep well at night. Who knows how long economic uncertainty and markets and pricing and all this stuff stays, capital availability. I mean, who knows what the future holds. So I think at minimum of 2 years would be, if, in the ideal world is where I'd live, and, ideally 3. 5 would be spectacular, but I don't think, that's necessarily practical. And 18 months would make me a little nervous.
Very clear answer. Let's talk a little bit about the industry. You have mentioned before about how the software industry is too immature, as you said, or not penetrated enough to be fully affected by market cycles. What do you mean by that?
Yeah, I mean, it's a great question. So in the short term, there will always be noise relative to buying cycles and budget freezes in companies. So let's start with that. But generally speaking, if you think about where software is, most of the world is still pretty analog, or it's at least a very old version of software. Give you an example. I have two teenagers. They go to school. I live in New York City. They go to school here. I walk into their classroom experience, their educational experience, not too dissimilar to mine, which was 30 years ago, which is not too dissimilar to my parents, which was 30 years prior to that. There's a huge amount of imagination and power to actually changing how we educate children and adults, for that matter. A lot of companies going after that. Billions and billions and billions of dollars of opportunity that sits in front of the right entrepreneurs who get that problem. So that is one little example of like just not a lot of penetration. If you look at agriculture, if you look at construction, if you look at legal, these are areas where there's just not a lot of technology adoption. Healthcare is something that's of recent getting more and more technology adoption. So we're still pretty early in all these transformations. And as new technology comes, even the stuff that was transformed over the last 20 years, there's ways to do it now. They're just fundamentally better. So we're now on some of these things. We're at a V2 because computing power, I mean, every 18 months, it really doubles in many respects. So what you can do with software and technology today versus 5 years ago it's truly mind-boggling, which is pretty cool. I mean, that's really why I get up in the morning. So you get to talk to entrepreneurs doing just crazy, amazing things.
To add to this, Jeff, and it's very much resonating really with our views, I had a interesting discussion with one of the very senior tech leaders. It's a competitor of yours. He said to me, look, today, as of today, only 10% of the global GDP has been disrupted by the internet or by tech. 10%, it's 3 trillion, including the market cap of all public companies. And with every expert you talk to, this number is assumed to go up to 30, 40% in the years to come. Is it 5 years? Probably not. Is it 10, 15, 20 years? Yes, that's an enormous opportunity set ahead of us. So going into this, and the market environment is of course challenging, but where are you as a firm and you personally currently seeing opportunities?
Yeah, we're looking across everything. I mean, we have a big team. We look at everything. We look at it globally. And what we're seeing is there are clearly verticals that are adopting technology at high rates. There are clearly infrastructure plays to support those. There are clearly things in cyber. So at the end of the day, if that 10% that you're citing, as that goes up, the infrastructure and security to support that has to come in. I mean, cyber is something we think about quite a bit. It's just a massive problem, challenge, and then investment opportunity at the same time. I mean, there's a lot of bad guys out there and gals doing bad things, and we have to protect the integrity of these systems that people now run their businesses on. And as more businesses run the critical infrastructure of their business, in a digital world, you got to protect all that. And that's an incredibly difficult problem to solve. And, the bad guys don't sit still, they get better. So the good guys got to come in and keep building more stuff. So it's a never ending opportunity in some respects. It's really fascinating to see. Ripe for opportunity for the right entrepreneurs.
Look, I came across a quite intriguing, I found another quote the other day from another, very senior tech investor in the US. He said, I've been working now with my investment team for over the past 10 years, but I can still not tell you whether my investment directors are really good investors. And what he's leaning on is obviously that more or less it was not an art, I dare to say, to make a 2x or 2.5x over the past 5 years. and probably, you know, difficult for people to differentiate between great investors, good and okayish investors. Let me ask you what, and you have a phenomenal track record. What is the difference, or why is your approach differentiated now in the years to come to generate alpha? Because now, in our view, it's really all about manager selection. It's not only more, you know, just play the private market portfolio, is work with the right guys, and with no doubt, Insight is one of them. But what makes you differentiated?
You know, it's a great question. So I would say early on, if you asked me this question 20 years ago, we're sitting here in, 2001, 2002, I would have said, well, you know, we're the only people investing in software. And I think we had a strong market perspective, excuse me, back then. But I do agree with, whoever, the person you're quoting. I mean, the last 10 years, lots of people have entered the software space, and it's picking great software companies, they'll do pretty well. So what we've focused on literally for the last 20 years are three things. One is getting a strong critical point of view and in an institutional experience set to actually sort through the myriad of opportunities that come to us. So if someone shows up tomorrow and has never done this versus our collective wisdom that we have over, literally 25 plus years of investing, and lots of people at the firm who've been there a long time, we just have a lot of collective experience sorting through the good and the greats. That's number one. Number two is we have a huge sourcing machine of deals. Our goal is to look at every deal that goes down. So we want to start with a massively big funnel, and then at the end of the day, pick a small number of companies. That's really the process and the approach. We've institutionalized that. We were the first to really institutionalize that. And we add intelligence, both people and systems, and machine learning and artificial intelligence to all that process. And then on the back end, once you have these companies, we talked about it a little earlier, we have a really big team of people, which we started, you mentioned Hillary, she joined the team over 20 years ago to build out this capability. So we've been building and testing and learning about how do we actually impact, growth companies. We actually hired a bunch of consultants back in 2000. We paid them a lot of money, and there wasn't a lot of impact because, they don't really know how to work with these tiny companies. These are 20, 30, 40, $50 million revenue companies. And we're hiring these massive consulting firms that are used to working with, BMW. And they come into our little company, they kind of squish it. So we basically learned over 20 years, and we're still learning how to have the most impact. Where can we have impact? And that's something that we wake up every day and think about. So we think we have an amazing sourcing machine that gets better. We have collective wisdom and experience. Our N is very large. I like to think about N. We have a large N. And then we have a team, literally hundreds of people that work to impact these companies on the back end. And in a world where, everyone's pretty good, to your point, how do you get better? It's going to be small stuff that actually makes big differences. And that's where we really focus.
Does data play a huge role in your selection process and artificial intelligence?
Yeah. So we have, so on the sourcing side, we have a huge data team that just looks at what has worked, what hasn't worked. And then we look at, public data sources. We also have the largest, or one of the largest, experience sets of software company investments on the private side, over 25 years. So our N is large data, and we can look at what has worked, what hasn't worked, why hasn't it worked. And it's a learning algorithm at the end of the day, right? If you do one deal a year and it happens to be a spectacular deal, you may think you're a genius, right? And at the end of the day, maybe you got lucky, right? So you have to look at this stuff over a big data set over a long period of time to start to separate out, to even begin to separate out what is luck versus skill. And even with a large data set, it's hard to tell. But if you don't have a large data set, it's impossible to tell, right? Because I did 2 great deals in my life, and they will outpay a lot of the bad deals, as an example, right? So yeah, it's a fascinating business and a fascinating thing to think about intellectually, and there's lots to apply.
Jeff, coming back to software and its potential impact, we all obviously aim to be good citizens and try to contribute. When you think now about the biggest challenges the world is facing today, what kind of impact you see software can have really to make things better, more on a broader global scale issue?
Yeah, I like to think of software as a tool, and that tool could be used for great purposes or not so good purposes. We talked about, cyber a moment ago, and, you can attack companies and governments and using it, right? So it is a tool that's not innately good or evil, but it's just a tool. What excites me today as we look at big problems, where data is going and where intersects deeply with drug discovery, as an example. There's a lot of cool therapeutics. You look at what Moderna did with the COVID vaccine. Essentially, if you look into Moderna, it's essentially a software company. They changed their processes. They built a company around data-centric processes, and were able to bring to market a drug in literally, days and months. So drug discovery is fundamentally changed. You couldn't do this 10 years ago. Education fundamentally changing, the ability to impact people across the world, not just in first world nations, but in developing nations with a device like this that could be in reuse plus some software, and change their educational ability to attain education and change their trajectory in life. Massive. So there's just, so I look at it and like, wow, there are entrepreneurs trying to do all these things, microfinancing programs and allowing people to get access to banking. So they're not, they don't have to succumb to payday loans. They can actually access fair financial deals. Kind of the menu's endless relative to what it can do in a positive way. And, that wakes me up. I think we hit 10 billion people the other day or whatever it was. And that wakes me up and gets me excited that, we're part of something that can actually be used for good. And the good news is I meet a lot of entrepreneurs that have just really good hearts and really want to, they're geniuses, and they want to solve good problems and actually have a positive impact on humanity. And I think that's our opportunity. The other piece is, you look at, the environment and you look at alternative energy, solar and wind, and all these different technologies. A lot of those are going to be driven by software. So, solar as an example, just the ability to manufacture and discover new technologies, it's all done and designed in software systems. So it's just, there's an endless number of positives that can come out of this.
Look, Jeff, you, I, and many others have seen cycles all the way back to over 20, 25 years. I remember, and I was still with KKR in these days, post-financial crisis or during financial crisis, post-financial crisis, Henry Kravis and George came and said, it's portfolio, portfolio, portfolio. That's your focus, get the portfolio right. And KKR later said, oh, we might have missed an opportunity to be more in investment mode. Blackstone, Apollo, interestingly, in these days, they changed gears and they were very much in investment mode, which paid out later. KKR, by the way, corrected its course or attitude post-COVID. They were the most active financial investor in the world. So anti-cyclical. What is your current focus? Is it portfolio? Is it sitting on the sideline, of course, fundraising? Or is it really that you think already about, call it, going long in light of the depressed or compressed valuations?
It's all of that. I look at our business like we talked about at the start of this talk. The highs are never as good as the highs. The lows are never good as the lows. And I think some of the investors that you talked about, they have nerves of steel, and they realize that, there will be mean reversion relative to values in the economy. And again, when it's really hot, it's not as good as they think it is. And when it's really not, it's not as bad as it is. So, from an investment standpoint, we invest through the cycle. We're going to invest through the cycle. It's the secular trend. There's nothing in our minds that say in 10 years, is the penetration of software in industries and consumer life, do we have a fundamentally different point of view on that? And the answer is no. We still have the same point of view that in 10 years, that 10% number you threw out earlier is going to be a lot higher. And there's no reason to believe it's going to be fundamentally different. Is it going to be different 6 months from now than it would have a prediction? Who knows? But we're playing for the long term. So in that vein, we'll invest across the cycle, and when we find great companies, we'll invest in them. In the meantime, our on-site team helps drive efficiency and growth within our existing portfolio companies. So the answer is yeah, you do both, I guess.
Jeff, let me ask you, without naming specific companies, but your competitive landscape obviously has quite changed over the last years. Yeah, everyone is raising, suddenly even buyout players, growth funds. You have the crossover funds. You have suddenly, sovereign wealth funds that are doing direct deals, who are also your LPs. What is your view on that dynamic? Because we hear from time to time that this is an unhealthy environment. Was it just en vogue over the past 5-10 years, and this is going to disappear, and the crossover people focus on public markets again? What is your read and view on this?
Well, number one, I think software in general, I think people have awoken over the last 5-10 years that it's a really exciting place to invest. So I think there will always be competition on a go-forward basis in that. So the notion that we're going to wake up in a year and have no competition is probably an unfair assumption. Having said all that, if you look at the return of our industry, growth and venture over the last X number of years, it's been really good. And the good returns attract capital. So everyone over the last 5 years was launching, to your point, some kind of vehicle, from whether you're strategic, whether you're kind of a fundamental owner of assets as a pension fund directly, whether you're a hedge fund, whether you're crossover, you name it, they're in it. What we've seen over the cycles, though, is those people that come in of late typically leave because it's going to be a harder period. So great returns, you get more competition. Prices actually go up in the short term. So everyone's doing well, which gets more competition. Prices keep going up, and at some point they come down, which is what happened over the last 6 or 9 months. And, people lose a bunch of money, especially the people that entered in the last, period of time. So I think what you'll see is, generally speaking, the level of competition will decrease. There'll be less people, and we'll start the cycle anew and afresh. But, again, I'll come back to the notion that there will be always, I think we're at a point where people have realized that software is actually a good business, which again, 15 years ago, people looked at us and like, why this software thing? Why is it a good business? So that's changed.
Look, as you know, our mission is this theme, democratization of private equity. And I've been to New York a couple of weeks ago and met with some of the larger, senior managers from the GPs, more in the buyout segment. And really, for most of them, it's a top 3 strategic item on their list. What is your view on this? Is it, that you say it's something really for prosperity for all? It's changing the world to the better, that we also give individuals that have been left out in the past to participate in the unprecedented value creation that happened in private markets, that we give them access? Or do you see or take a more skeptical stance and point and saying, this is an asset class that should be more reserved for institutional investors?
Yeah, I mean, I think, I think what you guys are doing is really interesting and very cool relative to allowing people access to things they historically have not had access to, and, done appropriately with the right balance and the right weightings. These are cool parts of portfolios. So I think it's quite interesting. Even high net worth individuals have historically had challenges getting into different funds. And, there is a lot of that, right? You take the top X% of the population, they have the means and the knowledge to do this stuff. And historically, the challenge was access. How do you can't just waltz in. So I think what Moonfare is doing is quite innovative and exciting relative to allowing people access to products like a lot of the big funds that you talked about. And, you know the returns better than I do, but, the historic returns of a lot of these big big buyout funds are, the KKRs of the world and the Apollos of the world. And, they're good. Right. So yeah, I think it's a really exciting opportunity for people.
Look, absolutely same view. Let me lean a little bit in the interest of the audience on your experience, and let's talk about past deals. I know there is not the one deal, but if you take one, of your first major successful deals that you have made, what made it special, and what did you learn out of it that made you an even better investor post this investment?
Yeah, the first really large success I had was with a company called Shutterstock, which was a marketplace for stock photography. So it was a teeny little company. It was doing a couple $1 million of revenue, and had met the founder. There were two competitors, Shutterstock and another player, and we bet on them. And it was really my first marketplace investment, and we helped the founder transform the company, recruit a management team, and grow the company. And ultimately, we took it public a number of years later. This is back, call it, a decade and a half ago or so. And it became a big public company. So it was a really good investment. But more importantly for me, it was seeing the power of technology transforming industries. So, what they did, and it's analogous to what we just talked about. Where are we on this front? Historically, if you were going to run a photo shoot, you'd hire a photographer, and you rent space, and you'd hire models, and it cost you $50,000 to get an ad. And literally, what Shutterstock did was they figured out a way to, using the internet and digital phones. They were just new at the time. You can create that, and they sold it for $3, literally, $3. So what cost $50,000 became $3. So massive deflation, and the market grew exponentially, and people started using this high quality imagery everywhere, right? And they built a business that became very, very large based on that. So it was transformational, based on the input of technology. And then it was also a marketplace dynamic, which led to a whole host of other investments. This notion of having, suppliers, lots of people on both sides of a marketplace. So it was highly educational to me in so many respects.
Flipping the side, and look, we are all human beings. Any deal, and there are probably very few, but any deal that you regret having made, and what even more interestingly, what was the learning out of it?
I mean, there's a lot of things that, haven't worked out exactly how I would have liked them to. I mean, that's just kind of life. You come to this business with humility, and if you don't have it, you learn it really quickly. So there's a host of deals that I look back on. I don't regret any of them in some respects. I would say the regret would be if I didn't learn from them. And all of them have taught me something, and they've all given me a gift. And most times the gift came with no return, right? Or very little return. But it was a gift of like, wow, you shouldn't do that again. Or wow, when you're doing this, think about these things. So it was really an investment into my process, my approach, my thinking, my philosophy. And if you don't, failure is really it's an amazing sharpener of wit in education. If you pay attention to it, it's painful. So most people actually ignore it because it's easier to kind of not worry about or think about failure. So I think, with challenges, you get learning. And if you embrace it and kind of endure the pain of the challenge, you come out of the other side much better. And that's really how I've dealt with companies that, haven't worked out the way I would have liked them to. Fortunately, it's not a ton of them, but enough that I've stubbed lots of toes.
Look, Jeff, our business is, as many other businesses, very much about people. And sometimes, younger people ask me, hey, Steffen, you're an entrepreneur. What does it take to become an entrepreneur? I want to do the same. And my answer is, look, why do you think you are a good, or you can become an entrepreneur. Now, you have met dozens of successful, super talented people out there. And, everyone probably knows the 0 to 1 in Peter's view on, the entrepreneur characteristics are more on the extreme side of things in the normal distribution. What is your experience? What are characteristics? What are personality features where you say, I feel this is a person that really can change the world?
I've had the good fortune working with a lot of really amazing entrepreneurs that have just done amazing things. Ryan Smith at Qualtrics, Reggie Agarwal at Cvent, Dominic Richter at HelloFresh in Germany, where you are. They're all relentless, number one. They really care about their people deeply, their culture deeply, their customers deeply. They care and they feel it. So it's not analytical to them. It's actually emotional. They may be very analytical people, but it's deeply emotional. And they literally spend their days in detail. So they know everything about their business, but they can also sit and talk to you and tell a story that will blow you away, right? So they can elevate to 30,000 feet and then dig into the details. And that's something that, there's a lot of great operators out there, but they can't tell the story, or there's a lot of great storytellers out there that don't get their fingernails dirty. And I think there's a special place where you have this idea, you're passionate about it, it's childlike. And I mean that they think, the business is like another child to them. They care deeply about this. They're impassioned by it. And it just, when you see it, you just know it, because they're obsessed by it. And it's fun to watch. And they're very special people. And this is why the world changes, right? Because, most people, when they hear no, they say, okay, I get it, I'm not going to do that. And when these people hear no, they're like, oh, why is that? And like, why can we let's do it differently. So they challenge conventional wisdom always, which makes them, fun to be with and interesting. And it's just a great way to spend a day when you have these people in your life.
So much resonating what you're saying. Look, coming back to leadership, and again, you're in touch with so many successful leaders. Any particular points where you say, this is something I have learned from the greatest leaders you have met?
I think the best leaders are extraordinarily present to the moment. I think they are spectacular listeners and not distracted by whatever noise is in your head, worrying about what had happened or what will happen. They're planners and they worry, but in the moment, you are the most important person. So they therefore become amazing salespeople, but more importantly, they understand why and what you want, because they truly, truly listen. And the only way to do that is to be truly, truly present and not have, most of us spend our days with, stuff bouncing through our heads. And that's, to be truly great, I think you have to have, unbelievable presence when you're with people and your teams. And that's what they do all day long.
Look, at business school, I learned the famous quote, culture eats strategy for breakfast. And then, frankly, in my early 30s, I never got this point around culture and why is it so important. And then at KKR, Henry and George, where we kept on talking about culture, and I really realized that culture is the glue that keeps everything together. Let me ask you, how would you describe Insight's culture?
I would say we are entrepreneurial, action-oriented, relentless, values-driven around quality of people, both our internal and external. We're non-political, so what you see is what you get, and therefore we're easy to work for as an organization, but we're easy to work with as entrepreneurial partners. And we want to get stuff done. I mean, we're action oriented. It's like, let's just do it.
Look, without flattering you, it's exactly what I am observing in our partnership. Really glad that the cultural understanding is so close, because this is also what we at Moonfare stand for. Look, again, leaning on your experience, and I'm always asking these questions at the end of our deal talks. If you could go back in time, what advice would you give your younger self?
It's a great question. I would, I'd probably tell my younger self to worry a little bit less. I'm a, incessant worrier. So I think about all this stuff, kind of enjoy the process more, and take more risk.
Very interesting. Talking about risk in our businesses, to some extent, we all have to take prudent, cautious, sometimes more risk. By the way, in particular, if you're an entrepreneur, as you're trying something out, what probably no one else has tried before you. What has been your strategy in coping with failures when it comes to risk taking and it didn't play out? And how did you get back up after them?
Yeah, I mean, let's start. I hate to lose, right? I'm like, I love to win. I hate to lose. So like, losing sucks. I think it all comes down to framing, though. At the end of the day, we're in a business where things we don't control. There will be outcomes because of whatever happen, and we don't control these things. So we can manage some inputs, we can manage some decisions, but ultimately, outcome is not what we can manage. So we can manage the process. So I think the key is framing it as a learning experience to say, okay, what did we learn from that? And these are painful. You have to go into pain because you've lost money or you've done this or whatever, or it blew up spectacularly in the media, for example, right? And these are painful things to deal with as a human. But if you're going to be a great investor, you literally need to actually go into that pain and explore why did they happen the way they happened, and learn from it. And I think that's really the key takeaways. How do we frame this as a learning experience? I always like to think about, there's a quote by Teddy Roosevelt about being in the arena with, the fighter in the arena with dust and the sweat and the tears. And at the end of the day, his point is, it's all about, you can be a pundit on the sideline, but you kind of want to be in it. And to me, that's the whole point of life. It's like, okay, I can not take risk. That's kind of boring. I want to take thoughtful risks, and I want to be out there and, at the end of the day, live a life that's worth living and do stuff. And if you do stuff, some of the stuff ain't going to work. And that's okay, as long as you learn from it. You don't want to keep doing the same thing over and over again. That would be silly, but if you learn from it, it's fine. But to do nothing because you're afraid of failure, that seems like a life not well lived.
Thanks so much, Jeff. One more and my last question, probably for today. Look, the past 12 months has been quite a roller coaster in many regards for the industry. What has surprised you in the last 12 months, and anything particular that you have learned, what you didn't experience in your vast, past experience from past crises?
I'm always surprised, and again, even this time as well, how high the highs are and how low the lows are, and how we collectively, as a community, as the media, we just don't see it, right? When you're in the highs, it seems normal. When you're in the lows, it's terrible. And, there's no moderation in any of it, and how we always overshoot as humans, right? It's like this, you can write a book about humans overshooting. I guess there's lots of books about cycles. It's just, we can never get the porridge right. It's either too hot or too cold. And it's like, how come we can't just get it just right to eat right now? So, I mean, that's probably the biggest, as I look back, it's like, we're always overshooting one way or the other, societally.
No, it's all about how you cope with it. When we talked about entrepreneurship, I was thinking, you have high days as an entrepreneur and you have the lowest days. So your fluctuations, your volatility in your mood is is very different from, let's say, an ordinary corporate job. Thanks so much, Jeff. That was terrific and really insightful. Thanks so much for being with us. And towards our audience, if you are interested to learn more about Moonfare, and if you want to get access to previous deal talks or be informed about our upcoming events, we are running some 50 city dinners across the globe where you can meet like-minded individuals, investors, and the Moonfare team. Please sign up and join our more than 50,000 professionals across the globe under www.moonfare.com. Hope to see you all very soon in one of our next deal talks. Thanks so much for your attention, and stay healthy. Thank you.
Thanks, Steffen.